Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 22nd of 2026. A lot of data to take a look at this week. Obviously, getting some new data related to the impacts of the Iran conflict, or I guess war, as we're now calling it, related to energy and some other commodities there, and obviously the impacts on the investment markets as well. But let's first take a look at the economy here. We have the Atlanta Fed GDP Now data. You can see here very clearly that the estimates have gone down as we have highlighted previously that these quarterly estimates move around quite a bit based on the available data and the emergence of new data. And you can see that that particularly back in 2025 in the second quarter, that data was highly volatile and caused a lot of noise before we got the eventual number, the final number for the second quarter. And similarly for third quarter, fourth quarter had particular volatility. And again, that is proving to be the case here in the first quarter data, which we will get the first reading of in the third week of next month, that being April. Right now, looking at basically around 2.25% annualized GDP growth. Slide over here and look at the conference board the index of leading economic indicators. Those continue to slide down. We see that year over year remains negative, although less negative than it had been about a year ago, but nevertheless negative, and we're now pushing about six here consecutive months of that when that month over month number is less than zero. So this has become a little less reliable in terms of a recession indicator, but it certainly calls us to take notice when you see this in a continuous decline and the year over year numbers remain negative. Take a look at the policy rate. We did have a Fed rate decision last week, keeping rates on hold. You can see that this is the most recent easing cycle, and the implied number of rate cuts in 2026 now basically zero because we had some greater inflation numbers that came out this week. Again, a lot of it is energy related. And I hate to use this word, but to the extent that the conflict is not extended, then that inflation tends to be transitory. But again, that's a four-letter word considering what happened in 2022. But that being the case, basically all of those rate cuts have now been taken off the table. In fact, as we'll see here in a second, we have more central banks that are probably on a bias of increasing rates rather than lowering them due to the inflation issue. Here we have the market implied probabilities, and as I mentioned, for a long time we were looking at rate cuts, that there was a relatively high probability of those, and then the Iran conflict, or I guess I'll just call it the Iran war, happened now. And then that was taken off the table because of the commodity-led inflation. And you can see that the probabilities of a rate increase have actually picked up. And you don't really hear the R word for recession as much, but it's certainly more prevalent than it had been when we were looking at these kinds of scenarios. So again, I think there's a lot of policy uncertainty in the air right now, and that's what's contributing to the market volatility that we see. Here we have the developed markets, central banks. You can see that the number of those that are expected to increase interest rates over the next 12 months. You can see that that was very steady in a very low number environment, and that has certainly picked up as these central banks are really trying to deal with commodity price inflation. So when the Fed meets, we get dot plots, we get surveys of future expected economic performance, so on and so forth, and this is a manifestation of that discussion. Oddly enough, and there's some oddities in the charts this week, we have the Fed increasing their estimate of long-run GDP growth from 1.8 to 2.0%, and it's just odd that it would come at a time where we feel like maybe there's less economic momentum here over the near term. But again, these are longer run projections, and these are updated every time the Fed meets, essentially every 6 weeks. Interesting that we see here, and this is the MSCI World 2026 EPS earnings per share consensus estimates. And, again, oddly enough, they continue to move higher. This time series goes back to beginning of 2024, but even, discounting like what happened in the second half of last year, I should say, that we continue on a fairly methodical upward trajectory with maybe a little bit of a fish hook there. But I think the takeaway on this is you have to back out the US, which is a really high percentage of this MSCI World Index. Here we have another chart that gives us maybe a slightly different vibe here. So this is a global fund manager survey. So this is, these are fund managers telling us how they think. And so the net percentage of those expecting a stronger global economy, again, we had seen that strong upward trajectory, but now we see a little bit of erosion there, which is what this circle is indicating. And then you've got the S&P 500 year over year. On the right-hand scale, again, we've had some noise, and obviously we've had more volatility, but we do see that ticking down a little bit. So maybe slightly different picture there, even though the earnings estimates for global positions continue to rise. So something I thought was pretty interesting that Torsten Slot mentioned in one of his notes, that this is the point, kind of the demarcation point, when the Fed started to raise rates. This is obviously 2022 was a very weak year, and we saw, at least in terms of private construction spending, that when rates went up, we saw general office, and again, we talked a lot about the office vacancies and whatnot, that construction spending on offices went down. But at the same time, data center construction went up, despite the fact that interest rates were moving higher throughout this entire time. And the thesis from Apollo is that data center anticipated returns on an investment were so robust that it didn't really matter to them that interest rates were moving higher and that their cost of capital was increasing, that they were still incentivized to continue to expand the construction of data centers. This is a chart again from Apollo, which I thought was very interesting. So when we had the sell-off last April, which oddly enough was almost a month ago now, and when we had the Liberation Day tariff announcements, there was this whole theme that was emerging about selling America, where you'd have stocks, the dollar, and bonds that would all sell off simultaneously, and this would be like the sell America trade, right? Well, that didn't pan out at all. In fact, we continue to see very, very strong inflows of foreign capital into our risk markets, i.e. equities. And what's interesting in this is, this goes back to 1971. You can see this whole period here, there was a much larger number of instances within a year where, you had this happen, where you basically had the sell America trade. Well, far less so, here over the last decade, and honestly, you could extrapolate that to the last couple of decades here. But in particular, 2026, as we sit here, the number of trading days still relatively low. So we just haven't seen as much of despite the volatility, we haven't seen as much of that kind of that core sell America trade as we would have expected a year ago. A quick shot of data here. We've got the Philly Fed Manufacturing Index, again, looking strong. And we've seen this consistent with some of the other Fed districts. New orders continue to be positive, and kind of like working within a channel here. This is not I would convincingly positive here because this data has bounced around quite a bit, but again, very consistent with what we've seen with other Fed districts. Wholesale inventories were down for the month. They were actually worse than expected. Inventories were expected to move a little bit higher, and that actually did not happen. Factory orders here we see were pretty tepid, but they did hit the estimate for January. Again, this data comes to us in a little bit of a lag, so next month we'll get February and so on. Now, if you back out transportation, that number looked a little bit better. It's about 0.4%. So, when you look at the Fed surveys and what we just looked at in the Philly Fed, that index being positive. If we back out the kind of the noisy and very volatile transportation sector, the 0.4% for the month of January was actually not that bad. Here we have producer prices, the headline producer price index. You can see here that it was hotter than normal. And this is one of the things that got the market a little bit unnerved last week. You can see that PPI headline inflation moving higher. You can see at the core, excluding food and energy, that's also moving higher. Both of these numbers that were reported for the month of February were ahead of expectations in the case of the headline number. We were looking for 0.3, we got 0.7%, so that puts year over year at 3.4%. And then I think probably a little bit more importantly on the core side, we were looking at 0.3 as well, got 0.5%, and then that is pushing that year over year number to 3.9% annualized. And we slide over here, we look at services, that was on the high side, 0.5. But then on the good side, you saw a real increase here, notable increase in that last reading. And core goods were maybe a little bit higher. They were down versus the last report. But really, the goods prices, you saw a huge bump in the latest reading. Here we have new home sales. Frankly, a very disappointing number. You've got the new home sale growth rate, at least for the month, was down at 17%. These are pretty weak numbers. That puts the year over year at negative 11%. And you can see on a trend line basis just how weak that was from a relative standpoint. Recessions, I think I'm hearing the conversation about recessions perk up a little bit, although the probabilities, I think we showed you this last week, have gone up from like 20%, which is really kind of as low as they generally go. It kind of perked up to about 40%. And, the longer the Iran war persists and the longer that we have these very high energy prices and, if things move higher in the commodity basket, that percentage of probability is going to continue to eke up. But having said that, we just don't see recessions as often as we did. Again, going back to and I love these long-term historical runs. When you go back to 1854, and you used to see recessions all the way up through like the 60s. Here would happen much more frequently than they do now. In fact, we went a very long stretch here, 128 months. And then we had another stretch in the late 1900s 1990s, I should say, 120 months. So, we generally do not have recessions nearly as often as we used to. Interesting data point here from Vanguard. We've got more hardship withdrawals from 401ks, and you can see this is not telling me that this is accelerating. It's just it's showing that this is a trend, and I think this has more of an implication for financial planning than it does like in terms of economic signaling here. Just because you have just the participant percentage use of these hardship withdrawals continues to increase, and again, these are withdrawals that need to be paid back, and there's generally a payback schedule where essentially you're paying yourself back. But in some cases, these loans are not repaid, and you just have lower retirements, and so this kind of gets my attention here when you see this percentage eke up to kind of towards the upper single digits on this as a percent of total uh, uh, contributions. S&P 500, we're going to slide over here now. You've heard about, some of the indices. The Russell 2000 is now in an official correction territory. I think importantly, from a technical point of view, we've eclipsed our 200-day moving average, which, again, if you go back to 2025, and we go back to the tariff announcements in April. We punched right through that, but then we kind of fought right back. So that was very relatively short-lived. Kind of the question is what happens now? This is something we take stock in because technical indicators do have some relevance in there, but as we're going to look in the subsequent slides here, we'll pay attention to valuation. We'll pay attention to what else is going on in the world, so on and so forth. Share price performance overall. You can see the U.S. Major indices. This is the MSCI USA ETF, and it's down about 6%. Global stocks, if you back out the U.S., are down a little bit more than 10. So this is the trade. Global stocks was the trade that worked out really nicely last year. And you saw a real updraft in those. And these are unfortunately taking it a little bit harder in the sell-off because of primarily the exposure to the energy side. As we've been talking about, volatility has naturally increased due to the conflict. You see that we were in a fairly low vol channel. That certainly picked up as we approached the conflict, and certainly now that we're in it. So you heard me use kind of this term transitory before, and that's why I tread very lightly in talking about this. But historically, when you have, and this is from Bloomberg Finance, as reported in Deutsche Bank's research piece, that basically in tracking 30 geopolitical events dating back to 1939, we generally go about 15 days into that conflict when we trough out, and then the market begins to pick back up again. This is the average, and this is the median in green. You can see, both of those really about anywhere between 12 and 18 days. They tend to trough out, and then the market goes back up again. And again, is this going to be different? We don't know. I mean, there seems to be a willingness to continue to prosecute this campaign against the Iranians. It doesn't seem like we're on the eve of any kind of regime change. But the usual time frame here for the weakness in the market is about 2 to 3 weeks. So we look at earnings. We were looking at earnings before, and they continue to move higher. This is the S&P 500 forward earnings per share. Again, just solid as a horse. And you look at operating earnings per share based on the various quarterly estimates. And honestly, you really can't argue that much. So the blue here represents the first quarter, and then you got the subsequent quarters of the year. And so the out quarters, the third and fourth quarter back end of the year, earnings are looking relatively strong versus where they started out. It kind of belies the current environment. If you feel like things are slowing down because of the tariffs and really more so the war, it's certainly not reflected here. And I think there is a thinking, again, owing to that last slide that shows that the impacts of this tend to be short-lived unless this becomes a huge conflagration. that we'll get through it, and eventually, the consensus will go back to we're going to have more rate cuts, and that the economy is going to settle in, and commodity prices are going to come down, so on and so forth. And I would say that this view embodies that thinking right now, that we're just going to, eventually plow through this, and this will be a short-lived endeavor. So here we have the forward PE. We're looking about 20 times now. This is, you see the average here is a little less than 15. I'll just call it 15, period. And you've got standard deviation dashed lines here, which just means that generally speaking, about 2/3 of all of your forward PE observations are going to be here. So we are definitely an outlier. So we're still more expensive as a market, even with the sell-off. And you can see here, you've got these various valuation metrics. You got forward PE again. We're above the historical range. You got trailing PE, trend PE, the Schiller cyclically adjusted price to earnings ratio, price book, dividend yield, and implied earnings growth is really the only one that we're in the range right now. All of these other metrics show us still outside of the range, or in other words, maybe a little bit on the expensive side. Now we'll take a look at basically forward PE of the index, which we just saw. It was about 20 times. Equal weight is 16. So now we did see some broadening out in the markets towards the end of last year and in the first part, I should say, of 2026. Equal weight is still on balance, kind of equitably valued. It's not cheap, but it's absolutely not expensive. And you've seen the valuations come down, I think, somewhat reasonably here on the tech-heavy cap-weighted index. Now we look overseas and we focus here. We've already talked about this in the domestic markets, but the global markets, excluding the U.S., are around 14, 15, and they, with the run up last year, 2025, these have gone. The valuations have moved higher off of this trough, but they're still relatively cheap to the U.S. Now, the chart that we've been showing you for the last probably a couple of months here in the charts of the week, you've got the institutional investors continue to be bearish, and you can see that the bearish sentiment under individual investors has moved dramatically higher, and this number continues to kind of spiral up, and you can see that these the net bearish sentiment continues to increase. And again, that's not to say that this is a harbinger of really bad markets to come, because we saw in 2025 we did have a fairly strong negative interest around those tariffs. Again, another headline issue that proved to be relatively transitory, even though we do have increased tariffs. Just we didn't have the impact that we thought we were going to have, based on the rhetoric at the time. Another interesting chart. This gives us some historical perspective. This is data that it goes through essentially the end of 2022, but it starts in 1950. So it does give us some very illustrative feedback here, that basically the market's going to peak about 6 to 7 months before a recession begins, and the market generally recovers about 6 to 7 months before the recession ends. And this, I think, so there is some predictive power, there is some correlation and leading characteristics of the market to what happens from a recession standpoint. And this, we're just using industrial production as a proxy for that, for kind of economic expansion. But generally, the market in duration, again, looking at this broad length of time here, it spends far less time in recession than in expansion. And generally, the GDP growth within those recessionary periods is only about 2.5%, compared with about 25% in expansion. Now, corporate earnings do go down but obviously if you're spending less time there, the net impact is not going to be that great when you consider that during expansions that earnings are up like almost 100%, and then job growth moving in a similar fashion. Now, if you translate that from economics to the market, you see here that generally you spend, as we've always talked about, a lot more time in bull markets. And, bear markets generally last about 10, 11 months on average, although, again, more recently they've been less than that. Total return, you get over, a stretch is, not terrific, but that's again looking at just the stock market. It doesn't look at other asset classes, and it certainly doesn't take into consideration what diversified portfolios can do in terms of limiting downside. But those bull market returns are very robust, and over time, this completely swarms that if you're a diligent investor and not get emotionally wrapped up and do irrational things based on the status of the market at the time. So Brent crude, we know, has gone up quite a bit. In fact, it's gone up really a lot more than we've seen WTI, West Texas Intermediate. Again, a lot of this is rhetoric driven. You can see by the magnitude of the increase. We've had some, kind of a couple of fits and starts here where it went up to 100, came down to 80 almost, and then went back up. So this is really what scared the market last week. Estimated hit to Persian Gulf exports we see here is about 16 million barrels a day right now. You're getting some offset because you've got the Saudis that are able to export out of another port on the Red Sea. Again, the question is, are the Houthi rebels going to try to make that a difficult passageway? But again, while the Strait of Hormuz is essentially shut down, that accounts for about 16 million barrels a day. Here we have the Treasury, 10-year Treasury plotted against Brent crude. And what I did not honestly, I knew that there was a correlation, but I didn't realize that the relationship was this strong. And so you can look at this as kind of an interesting proxy, oil, what it's doing to the interest rate market. And we're seeing obviously some changes in Treasury yields as a result of the rhetoric that's being discussed that we've already referred to. But just to highlight here that there is actually a very strong relationship between oil and 10-year Treasuries. Oil refiners, not too surprisingly, are getting some pretty strong crack margins. It just means when they crack the crude into its distillate products, that you're seeing some pretty good processing margins on that with higher prices. Exports to Asia moving higher. Again, not too surprising there, knowing that a lot of the output that crosses the Strait of Hormuz is destined to Asia. We're trying to fill that gap. Japan, in particular, imports like 95% of its energy. China, imports a lot of the crude that goes through the ports. We're not necessarily sending crude to China, but we are sending crude elsewhere in the Asian Rim. Here we have interest rates. We've got break-even inflation rates at the 1-year level that have really rocketed higher. Looking now about 5.3% is kind of the break-even rate for the Treasury inflation protected securities, or the TIPS. So this is essentially the market's view of implied inflation 1 year from now, which obviously is in stark contrast to what the Atlanta Fed is projecting, and that is looking a little bit more tepid at about 2.2%. So this has the potential of getting pretty volatile and getting ahead of itself, but at least this is what's being priced into the markets right now. Here we have the yield curve changes. You can see here on the left-hand side that essentially, we've had a flattening of the curve. So we had indicates a negative or inverted yield curve where essentially 2-year yields are above 10-year yields, and that has reversed course. It did that back in 2024, and we got increasingly steep in that yield curve, which is a very healthy dynamic. Here we were looking at something that was almost close to 80 basis points, and now we've taken a good chunk of that yield curve slope out of the equation. You can see here, even on 10 to 30 year, and 30 years are the longest term maturities out there, and you can see that the curve is flattened a little bit, actually below its 200-day moving average, which is pretty impressive from a data standpoint. Here we have fertilizer prices that are impacted as well by the Strait of Hormuz closure. So we look at this in view of the fact that it's not just energy or oil that's impacted here, but it's urea, which is a big component into fertilizer, and you've got kind of fabricated fertilizers that move through on these transport ships as well, and you can see that those prices moving higher. Gold futures, we've seen a fairly strong pullback in gold and silver as well. As we were talking earlier this year, we felt like silver was definitely, getting ahead of itself here, and it certainly has shown a fairly dramatic correction. But both of these, and I'd say palladium and some of the other, the precious metals have also taken a hit as well. Here we have the dollar. The dollar had been moving a little bit higher, and you can see that that has certainly reversed itself. Now, our final chart is something I think puts a lot of things into perspective and just how far we've come. And I'm reading a book on AI right now, and reading a book on basically the evolution of intelligence. And this is a technological disruption, basically starting from 1000 AD, and you can see that not much happened for a relatively long time. And what we've seen over the last, really call it the last 150 years, has been dramatic. And Rick Reeder at BlackRock talks about this all the time. And I've always thought it very fascinating, when you talk about factor productivity and economic growth, and these are the engines that help produce that productivity, that's helped to keep inflation a lot lower. I'd say up until about 1950, 1960, it was not uncommon to have, 3 to 4% inflation every year. And since the 1950s, and 1960s, that average inflation rate has come down, and it's not quite half that, but literally you look at over the last 25, 35 years, even 40 years. I mean, that average inflation rate's closer to around 2.5%. So we've had a tremendous benefit that I think we all kind of largely take for granted, because we're getting these new toys in real time, and we're really not stopping to take stock of the progress that we've made from a technological standpoint over these many years. That's all we have for the chart pack this week. Hope you have a great week, and we'll talk to you again soon.